Hello, everybody. This is Nikki from Motherhood Unfiltered. Is going to be okay. And today I have Troy Holt on the line with me, and he is the CEO of Troy Holt Consulting LLC. He is a co-author of the Amazon bestsellers book. He has his own podcast, and he is a financial educator licensed in 13 different states. So, but before I bring him on, um, please remember if you're watching on YouTube to comment, like, and subscribe. If you've already done that because you're awesome, then share it with someone that you care about. Also, if you're listening on the podcast, I would appreciate if you would go to Spotify or Apple iTunes and uh, leave us a review there. So that just lets me know how well I'm doing. And trust me, when I get a review, I get so excited about it. So I hope that you will do that for me. Also, as you can tell, my voice is a little hoarse. We've been under the weather over the holidays, but I'm okay. And so without further ado, let's bring on Troy Holt. Hi, Troy.
Hey, Nikki, and hello, everyone is listening. Happy New Year.
Happy New Year to you. I'm so glad we finally got to talk. I've been anxiously wanting to talk to you because you talk about um, financial things, and I am the worst financial person in the world. But I am trying to do better. And so I feel like if I'm trying to do better, then there's other moms out there that are wanting to do better also.
Yes.
Let me um, get this ticker off here because make sure it's hiding here. I think it's a slow connection, maybe.
hmm
That's going to bug me until it goes away. Okay. Well, while that's figuring out what it's doing, so tell us a little about yourself and how you got started in becoming a financial educator.
Yeah. So a little bit about me that for those that don't know, I think last time we talked, or my bio may have said 13 states. It's now I think 20 states since it's been updated. So
Okay.
I've added from a few more states. Not none of you, Nikki. You just the I've been adding for the last few months, so some states. But yeah, so I tell people, on Clubhouse, this is my elevator, what they call an elevator pitch. My name is Troy.
Yeah.
I own a company called Troy Holt Consulting. I'm the CEO. The CEO stands for Chief Encouragement Officer. My title is
Yeah.
my personality. Literally, my title is my personality. I'm one that loves to encourage and support others. And so I kind of play on words, but it's Chief Encouragement Officer
Mm-hmm.
is what the CEO stand for. But I've been in the
Mm-hmm.
financial services industry for about 22 years. I'm a certified financial educator. I'm on a mission to eliminate financial literacy. It's a big problem, especially in the African American community. And so I
Mm-hmm.
really want to be able to, if I can just help one person,
Right.
the masses is fine, but if I can help one person to be able to not only help them to in education, but also implementation. So once you get the education, you still got to do something with it. And
Right.
so I'm big on education and implementation. And so that's a little bit about me. If you got more, please feel free to ask me. I'm kind of what they say an open book. Anything that you want to ask, feel free to don't mind answering.
Right. So I did put got us some questions to for me
Mhm.
to ask you. So what would you say is the biggest financial crisis that we have in our country?
In our country, and I can add this into globally, is financial literacy. They've done a test where only 30% of the people that take the test was financial illiterate. And it was some simple
Mhm.
things, and it's just a lot of simple things, because remember, we're not taught in school. Our parents haven't taught us. We don't get it from our friends. In
Yeah.
school, in school, 20 Florida make 22 states, but they hadn't implemented. And I think it's another state that offers some type of financial education in schools, but it's mostly
Mhm.
like how to balance a checkbook or things like that.
Right.
Something real
Right.
basic, but no true financial education. So I think financial education is the biggest issue going on right now.
Yeah, I completely can attest to that because when my boys were in school, they didn't have any kind of um, class to teach them how to save
Yeah,
money, how to balance a checkbook, or anything like that. It
true.
was really disappointing, and I had to, teach them what I knew about it.
Hmm.
And
Hmm.
and then today, with everything being so, we always had cash. Growing up, we had
Hmm.
cash. That's how
Hmm.
you knew you had money, or you went to the bank and got it out. Well, now you can just buy and sell without even having cash in your hand.
Right, true.
And and I think that's, a disadvantage to us because we don't see it. We just assume it's there. And
Hmm.
before you know it, you have no money in your account.
Yeah,
So,
it's
um,
easily been there, done that.
oh, for sure. Yeah. So what is this rule of 72? I saw that. I was like, what in the heck is that? I mean,
Yeah, so the rule of 72 is a very simple rule, and this rule can work positively or negatively. So the rule of
Mhm.
72 goes like this: take the number of interest rate. So whatever you get in this, so you have a checking, a savings account, and you get one
Mhm.
percent interest. Okay, divided by 72. The answer that you get will tell you how long it takes for your money to double. So if you take 6% divided by 72, it takes 12 years for your money to double. But if you go back to the 1%, then it takes 72 years for your money to double. So most of the time, people are not aware of this.
Oh
Uh,
Lord.
they are not aware of this rule of 72. Now that works on the opposite side. If you have
Yeah.
if you have an interest rate of a credit card of 12%, divide that by 72, that credit card company is going to take them 6 years to get their for their money to double.
Oh
So
God.
the rule of 72 is a rule dealing with compound interest. And
Yeah.
Albert Einstein says the eighth wonder of the world, but it works for us on the positive side and it works against us on the negative side.
Oh my Lord. Nobody would even thought of that. They
Right,
don't even think about interest rates when they're like, oh, this company gave me, a
right,
$1,000 to
right,
play around with.
right.
And but they're actually thinking, well, you're gonna be paying us more than that back,
Yeah, right.
depending on the interest rate.
Yeah.
Well, I never even knew about that rule of 72. I thought, is that the 72nd rule of financial law or something like that?
No,
You
it's
know?
just it's something that Albert Einstein came up with, and dealing with compound interest. And if you
Uh-huh.
go back and, like I said, it's an estimate. So you take the interest rate you're getting divided by
Mhm.
72, then you can kind of estimate how many years it's going to take your money to double. So whatever number you plug in there divided by 72, whatever interest rate you're getting divided by
Mhm.
72, then it's going to tell you the answers, approximate estimate of how long it's going to take, for how many years it's going to take for your money to double.
Okay, well, that's a good tip to know.
Yes.
Um, so the So with that, how does that come into play with? So if you are, you're worried about your interest rates and how
Hmm.
much you're going to be paying out,
Hmm.
how does that? You had another question on there that says the percentage of Americans that do not have enough to cover a $400 emergency. I mean, is that a high number or a low number or?
Yeah, it's a high number. I think the number, if I recall correctly, is about 68% of Americans don't have enough to cover a $400 emergency. So, basically, if the refrigerator go out, if they
Mhm.
need four new tires, most Americans don't have a $400 in the savings account to go handle that. And now there's small solutions to that. You might be asking, well, Troy, what is a solution? And one of the
Mhm.
solutions
Yeah.
is to pay yourself first. Now, most people they get their paycheck and then they go pay bills, and they may go splurge and pay bills, but it's truly
Mhm.
paying yourself first. Now, I'm a man of faith, so I'm gonna take care of God's, and then take care of mine,
Yeah.
and then pay everything else first. Now, some people they don't believe in God, but they should pay themselves first. And so
Right, right.
the key to this, Nikki, is not the amount. Now we
Mhm.
want you to get 400 and more, but the key to this is to start. And if you start say, okay,
Yeah.
I'm gonna pay myself $10 every paycheck,
Mhm.
you have implemented 10%. It doesn't matter the amount or the percentage, but you got to start somewhere. If you can't pay yourself $1, you definitely can't pay yourself 10. So wherever
Right.
you start. So what it does, it disciplines you. It gets you in a
Mhm.
mindset, and it gives you in a habit of always every time you get, even if you get a gift from someone or somebody give you something, remember to pay
Mhm.
yourself 10%, and you set that aside. You can do it
Mm.
automatically. Maybe if you not good, you can set up an account with your bank, and if
Mhm.
you get direct deposit, so I'm gonna put $25 every paycheck over in this account. I
Yeah.
remember for years, me and my wife were doing it for years. I remember there was time that I would have to take the money that I set aside and use it to cover the bills.
That was my next comment because, well, I mean, it,
But now today I religiously do it. You see what I'm saying? I got in the habit
yeah.
of doing it now. So now I don't have to use that. But it was
Mhm.
time that I had to use it because I had to cover. But I got in the mindset that I'm gonna pay myself first, and I set that as a rule and a principle. And if you do that, eventually you get a you
Uh,
and then you get a raise. Okay, well I've been paying myself. Okay, let's put the whole raise in there or part of the raise. Let me pay my,
yeah.
and then you go on and on and on and
Well, I mean, I do that. I put a little bit of money every week
on.
into my savings, but there are times, like you said, I get into it because I feel like I need it to cover something else. And
Hmm.
then I feel guilty about that because I'm like, well, what's the point of even putting it in there if I just get it back out
Right.
every week, you know?
Right. Well, what you want to look at is number one is paying yourself, but also setting up an emergency fund. Now, the emergency fund. Now,
Hmm.
the rule of thumb is 3 to 6 months of your income, but it could be an
Hmm.
amount and that you're comfortable
Hmm.
with. So you want to
Hmm.
put it to that amount. And so once you get to that number of whatever it is that you feel comfortable at, then if you
Hmm.
have to use it, it's what it's for. Emergency. Now it's not, it's emergency is not if you see a purse or some shoes on sale. That's not an emergency now.
I don't know, Troy. Sometimes that is. That feels like a that feels like, like a mental health thing that I need to take care of at the moment.
Right, understood. uh and and
I mean,
and, and they're emotionally it's good to you worked and you go buy yourself something. It's kind of
hmm.
like when a person is going on a diet or fasting. So it's not wise to go and just splurge, but a little bit here and there is okay. But
Yeah.
it's the key is to paying yourself and setting up an emergency fund. Remember, about I think it's the number 68% only have doesn't have $400 cover an emergency, and so we want to get people where they out of that percentage where maybe they got a
Hmm.
thousand. What
Hmm.
one thing people can do, a lot of people get an income tax check, especially if they're single parent. They could
Hmm.
pay themselves and put something aside, because
Hmm.
everybody going to have a rainy day.
Yeah. Yeah, that's true. I do like that concept of paying yourself.
Yeah.
And I I mean, if anybody's like me, they either one feel guilty about paying themselves when they got this mortgage that they should
Hmm.
put all the extra toward. But I mean, also it's nice to have a little cushion,
Yeah,
when there
yeah,
is a little extra in the bank, then
yeah.
you're not like worrying about did I miss something coming out of my
Hmm.
account
Hmm.
and it's going to leave me short before my
Hmm.
next paycheck comes, right?
Right.
So,
Well,
yeah,
my recommendation, Nikki, even with that, is not either or, but both.
mhm,
So pay more on the mortgage, but also pay yourself. Because here's the reason why. If you
mhm,
get the house completely paid for and you have
mhm,
a water heater go out, you cash poor. So you got to
yeah,
go probably borrow again to pay for the
yeah,
water heater. So my philosophy is to do both. Maybe pay a little bit less on the extra on the mortgage, or put something aside
mhm,
in case you need it and you need it. And so, but everybody
right,
has to kind of do what they feel comfortable for. And a lot of it is our
mhm,
philosophy, how we were brought up.
mhm,
I'm not a big fan of even people coming up with a large chunk of money and just paying a house off, because you're gonna be cash poor
mhm,
and you might not live in that house for 10 years and then you want to move. And especially if like me, I'm 55. So
yeah,
if I ever bought a house, another house, now this one doesn't have it. It definitely wouldn't be have an upstairs. I can feel it now when I go upstairs, my knees. So if I bought a house
mhm.
with 2 story, I'm gonna move probably within 10 years because I'm not gonna be able to make go up and down those stairs. So things like
Yeah,
that you have to consider.
yeah, yeah. No, for sure. Those are, good ideas. So, so whenever you mentioned that, African Americans are,
Mhm.
they are poor, they have poor financial habits and things like that. Do you think it's just, is this cultural thing or, um, and do you think that how they were raised or how you're raised,
Mhm.
definitely plays into as an adult? I mean, we grew up poor too, and I mean, I feel like from the way we were raised is how it has impacted
Mhm.
how I manage my money.
Yeah. So for American Americans, African Americans,
Yeah,
it's a combination, and it's 4 areas.
yeah.
So first of all, in America, the median net worth for a white family is 189,000. For a black
Hmm.
family, it's 24,000. And if it's a single black female household, it's 7,000. Now, here's the
Hmm.
combination. Number one, the government. You got to go back and look at history. There was a time
Yeah.
when the government had something called redlining. So redlining
Hmm.
was it was blighted areas or areas that banks wouldn't loan or give loans to, because it was mostly minorities in those areas.
Hmm.
Uh, so
Right.
so that was a government set up issue, but also it was corporations was a part of that because they would loan money in certain areas. So remember,
Right.
uh, a lot of generation or wealth came from real estate. So you had people weren't able to purchase homes and get these mortgages, and
Hmm.
so you had those issues. And then if you also with that, the those places were not able to get monies from government and everything, taxes, because
Hmm.
it was lower, property values was lower, so the schools didn't get the money. So it's a combination of things. then it was
Right. Right.
then it was society. Society, didn't want Black Americans to live in certain areas. They didn't want to mix or commingle. They had areas.
Hmm.
And then lastly, the final area is us. We have to take some
Yeah.
responsibility of not teaching our kids money principles, not learning sometimes, and this could be for any race or individual, but
Right.
sometimes we will purchase liabilities instead of assets. So it's a combination of those things, and the government
Hmm.
and society and corporations are not the sole issue. It's some of the problem
Hmm.
is us also.
Right. Yeah. I can see that. I just, I just feel like that like you said, we need to be make more aware of these things that are going on,
Hmm.
because
Hmm.
even though, we may have been raised, at a disadvantage, that doesn't mean that we have to continue to be living
Agreed.
at a disadvantage,
Agreed. Agreed.
and
Agreed.
and I feel, today is a great opportunity for us to improve ourselves and better
Hmm.
ourselves, whether we're a single parent, or, a two-parent household, or whatever the situation is. The one thing that I feel like that came out of this pandemic is people are thinking outside the box,
Yeah.
and they're not just doing their 9 to 5. They're
Yes.
realizing that they can go out there and have their side hustle and make some extra money,
True.
to improve
True.
their lives.
True.
So,
Agreed.
so, so how would, what would be the first thing that someone would need to do? They're like, okay, Troy, I totally suck at my finances.
Hmm.
How do I get a grip on this? I'm in debt and I live paycheck to paycheck. What would the first thing I would need to do to get myself on the right track?
Yeah, great question. So we have something that we teach and we educate on. It's called the 7 money
Hmm.
milestones, and it's basically
Hmm.
a roadmap or a blueprint.
Hmm.
And the first milestone is get an education. So the first thing is read books,
Hmm.
YouTube. Be careful though, some YouTube stuff because you can get some
Yeah.
misinformation. But YouTube, Google, but also sit down with a financial professional that you
Uh-huh.
trust. So that's first
Right.
one, get the financial education. Number two is proper protection. So what that means is make sure your family is protected in event of your death or disability. Your family
Hmm.
can still function. So you want to look at of that one and make sure that's covered. Number three is
Right.
emergency fund. We talked earlier. I think
Hmm.
68% of the people only have a $400 emergency. So you want to start working working on that emergency fund. Some of these are
Hmm.
simultaneously. Some of them,
Hmm.
you might have to take step one and may take 6 months, and step two. But you want to work on it because it's not something just an event; it's a process. Uh, number
Right.
Number four is debt management, making sure you're managing debt. Do you need to pay off some debt? Is it going to be the
Hmm.
snowball method or the avalanche method? Getting out of debt and staying out of debt. Number
Hmm.
five is cash flow, figuring out ways to generate more money to come into the household, which could be maybe reducing your W-2 to get more money in the house and get a big tax return.
Hmm.
It may be starting a side hustle, whatever the
Hmm.
case may be, to be able to create the cash flow. Then number six is where you want to start building wealth. You want to start investing in certain areas to be able to build wealth and grow. And then number seven is everything that you built, you want to protect it. Do you have wheels? Do you have
Hmm.
trust in place? Everybody doesn't need a trust, but some people may.
Hmm.
But having wheels in place, and also making sure you have the proper beneficiaries on. You have a bank account or a retirement account. Make sure you got beneficiaries on there, and then a life
Yeah.
insurance policy. Make sure you got beneficiary on there, and make sure the beneficiaries are not minor children. Because if you put minor children on there, it's not wise. Because minor children, they can't accept assets like that. So there's ways to do that to get around that. So those are the things that I would tell somebody, hey, let's start on this path of this journey, this roadmap, this blueprint, and get you to from 1 to 7.
Well, that sounds like you put a lot of thought into those 7 rules, Troy.
I didn't create them, but I do believe in them, and I do implement them.
So, what is one of the most underutilized financial vehicles that legally avoid taxes? I think I might know this one.
Well, there's two, okay, so there's three instruments that you can use and be tax free.
Uh-huh.
One is a some federal municipal bonds.
Hmm.
Uh, Number two, a Roth IRA. And number
Okay.
3, cash value life insurance. Those are the
Okay.
way. Those are the things that allow you to grow wealth, uh, and distribution can be tax free. I like the life
Mm-hmm.
insurance one better because you kill 5, 6 birds with one stone. If you do a Roth IRA, you're limited to about 6,000 per year. But if you go with a life
Yeah.
insurance policy, depending on the death benefit, you can go much more.
Okay. So cash life insurance, is that what that's
Cash
where
value.
you cash value. Okay.
Mhm. Permanent life
The
insurance. So you have term and you have whole permanent, which would be whole life and index universal life. So like the whole life
hmm
and the index universal life, those types,
hmm
you could grow wealth and cash in it. And like for an example, I did an illustration of someone, a 1-year-old male, and if a person
hmm
puts $75 a month, 1-year-old male, they put $75
hmm
a month until that child turns 65. That child have about $443,000 tax free.
Wow. And the government won't come and get it, or will they try?
No, they won't. Mm-mm. Now, there's a certain way you have to take the distribution that is not taxable, but it's your money, and
hmm
we'll show you how to get it where it's tax free. And a lot of people are
Okay.
doing it. This is one of the strategies that wealthy people have been using for years that most people are not aware about. And now
I don't
part of me
know.
is educating people like that. Like I said, $75. If your person have a child or grandchild, 1 year old, I ran the numbers, $45. Now, if they put $150 in there, it would be even more. I just did
Yeah.
$75.
Yeah. Well, if I could start putting out life insurance on my husband, he's going to get very suspicious of me. So,
You're gonna be asking,
I,
what's going on here, Nikki? What you trying to do? Are you trying to take me out? Are you so every time you fix something to eat or something to drink, he probably looking over his shoulder like, what is this, right?
yeah. Yeah, he'll be teasing me about it,
Yeah.
but. But so you said what was a Roth IRA? You
Yeah.
said that's limited to a certain amount every month, every year.
Yeah, about six. I think it's 6,000 this year. Each year you can put that's the maximum you can put in a Roth IRA. And
Yeah.
if it's a couple, it's 12,000.
Oh, okay, okay. So and then that just sits in an account and
Hmm.
it just earns interest. Does that earn interest or how does that work?
Yeah, you'll be invested in something probably more like some type of mutual funds or stocks. It depends on the type. The downside of that is you can have
hmm
market losses in a Roth IRA. In a
Oh,
cash
okay.
life
Yeah,
insurance, you won't have market losses. That's why I like
gotcha.
the life insurance. Some people don't. Everybody don't like the life insurance. Some people against it. But what I tell people like this, Nikki. I say there's so many financial instruments, and it's like building a
hmm
house. Each
hmm
one is a tool. And if I was building a house, I could use a hammer, I could use a saw, and I can use a drill. Each tool has its own
hmm
particular function. It's not one is better than the other, but whatever I'm trying to accomplish, it has its own particular function. And that's the same thing with financial instruments.
Right, because you're not only, building, wealth that you can use, but in case, you do pass away,
Hmm.
they
Yep.
have that money that they
Correct.
can take care of all that, your
Correct.
expenses and stuff like that.
Yep.
Um, so, um, well, I had a question that popped up because of that, and now I don't remember what it was.
I do
I
that
saw on
sometimes.
your website, I know. I saw on your website that there is a book. Is that the one that you help co-author on Amazon?
I did not co-author that book. It's a book was written by uh, Tom. Man, I can't forget his name. I can't. Steve Siebel and Tom Matthews. And it's
Okay.
a book called How Money Works. It's a
hmm
book that what basically what we do is it's an educational, entertaining book. It's not a book for Harvard grads. It's a real simple book. Middle schoolers can read it and understand. It's a part of that
Yeah.
educational journey. If someone reach out to me and say, "Hey, Troy, I'm interested in the book," I will. I get their mailing address. I would mail the book to them for free. The only thing that I do require to mail the book is they sit down with me with a consultation and let me show them how to implement some of the things in the book. But there's no obligation for them to do it. But I want to show them how it works in the book. And so that's one of our key things. The book has been on, I think, about over 200 videos now, clips on news talking about in 2020 and 21, it was a top financial book. Real simple book, nothing educated. I mean, nothing complicated, just very educational and entertaining.
Yeah, I saw that, and it really interests me because sometimes I feel like we tend to overcomplicate things or overthink something, and we really just need to quote unquote dumb it down, and sometimes that's just the best way to learn how to do something is just, simplify it.
Yeah.
So, well, there went my other question. I had a really good question about that, but I just feel like, oh, I know what it was. You mentioned an avalanche or snowball. What in the world is that?
So the snowball method is paying off debt. The snowball method is you take the, let me make sure, I could reverse it. Well, but snowball is you take the highest balance and you pay it off first on credit cards. The snowball method is you take the lowest balance credit card on the snowball and you pay that, and then that payment, then you take it and knock out the next credit card. And then once you knock that one out, then you apply it and you continue to your snowball. Then the avalanche is you tackle the highest, interest card that has the highest interest rate. You tackle that first and stuff like that. So you got two methods in eliminate debt: snowball or avalanche method. And it depends on, your philosophy, which one you think are better. Dave Ramsey mentions the snowball method a lot. That's his style, the snowball, but you do also have the avalanche method.
Okay, so, and that would just mean, because you would take that money that you've been paying on the one debt and apply it with extra or what you were paying.
Correct.
Because I'm assuming you're still paying on everything.
Correct.
And you would just start consolidating the payments so that you start paying things off faster.
Yeah. So if you're paying $100 a month on a card, the smallest one, and then you paid it off, and then that next month you would take that $100, the second card. So let's say the second card, the normal payment was a $150. So that second card you would be paying $250. And then once you pay that, say you pay that out in 6 months, you take that $250 that you're paying and then pay that third card, and then so on and so on.
Okay, I got that. Well, see, that's why I needed to have this conversation, Troy, because I would never have thought to have done that. I would have been like, oh, I paid that off. I've got an extra $100,
Right. Yeah.
And so now I know I can just add that to, the next highest payment that I have and get that sucker paid off, But I feel like a lot of people, if they're like me, would get more satisfaction out of just paying it all off at once, and I think that I wouldn't have money to pay off the whole bill at once until like 30 days. And then then before I know it, I either forgot or I've gotten a late payment or I got interest fees. And then I'm even more of a bigger hole than what I started out with instead of just slowly, paying it each month.
Now, if you one that you put some on the card and you pay it off, this doesn't apply because you don't have no debt. But this is for people who, they got a few $1,000s in credit card debt, and they, if you go look at it, and
Hmm.
it tells you how long it's going to, most of them do, a lot of them do, say it may take you 15 years to pay off this $3,000 debt if you pay the minimum. So most people
Mm,
pay,
yeah.
the minimum, and then, they get on the interest. And same thing with a house. If you go back
Hmm.
and look at your mortgage and look at your the last page, I can't think of the name of it, but it gives you a breakdown of the payment history, and
The,
you'll see how much you pay in interest, and you'd be like, wow.
yeah. Yeah. So, and that rule of 72 would apply to that also, right? I
Correct.
mean,
Yep. Yep.
yeah.
Yeah. That credit card, if they pay,
Well,
if you pay 20% interest, and they divide it by 72, whatever, 20 divided by 72, that's how long they're going to take that credit card money to double.
I love it when we get mail and, we get mail and you say, oh, you're pre-approved, and you open it
Oh,
up and
yeah.
it's like
Yeah.
19 something percent. You're
Yeah.
like,
Right.
screw
Yeah.
that noise.
Right. True.
I'll just be poor.
Yeah.
And that's the thing. They don't teach that to kids in school anymore,
Yeah.
and I always use my youngest son as an example because he's really, he's doing so much better. But when he first, was out on his own, he struggled so much with being an adult, right?
Hmm.
It was so hard, and he didn't have any money, and he wanted this and wanted that. He kept looking at what he didn't have.
Yeah.
And I told him, I said, Bub, I was like, you have a place, you have a house, you have a car, you have a job, you are paying your bills, and you have food. What, I mean, I know you want, this new game that come out,
Hmm.
but you're doing all this on your own now. You are going to have to save for that if you don't have it extra. And so he told me a few weeks ago that he had, almost $1,000 saved in his account.
Good.
And I was so proud of him for
Yeah.
doing that.
Yeah.
And
Good for him.
I said, that is such a good thing for you because now you, you don't have to feel like you're wanting something,
Hmm.
because you have this little cushion, and you'll think twice about just going out and blowing it because it took you 7, 8 months to save that up.
Right.
And
Right.
I just wish that I heard more stories about that for, young adults and for even people who grew up at a disadvantage.
Hmm.
It's just been so hard, just trying to take care of your family, and then when we had the housing crash, in
Hmm.
2008, and then the COVID, and now recession. I mean, you tend to like learn how to live without things,
Right.
because you just don't have the money. So, have you had the opportunity to talk or help people who suffer from some kind of like money trauma, or like PTSD from how they were raised and not having money, and then now they're adults, they're struggling with that?
I have not, there are people out there. I went to a conference, um, and I didn't get to
Hmm.
go into this was back in October, September, to a conference called FinCon, and they had a
Hmm.
session called Money Trauma. I did not get to go to the setting, but I am
Hmm.
seeing more people like on Clubhouse and other people. I remember they was, talking about, money trauma.
Hmm.
You great point. I can use myself an example. I was raised a single parent, and I remember for my from year one through
Hmm.
5, we lived in the housing projects. My mom was
Hmm.
on food stamps and welfare, and so
Right.
I watched my mom, end up going to school. When we was
Hmm.
teenagers, she ended up becoming a nurse. When
Hmm.
she passed at 14, but she was making almost $100,000 a year in the nursing field. But I've seen her, go from there. I remember my mom. I remember she got arrested for food stamp fraud, and I was a kid, didn't really know, the whole
Uh-huh.
detail behind it. So after my
Uh-huh.
mom passed, I was going through documents, and I remember she was trying to get her insurance license. Well, I mean, sorry, real estate license. Now she already had
Hmm.
nursing license, but she's trying to get real estate license because she wanted to maybe start getting into real estate. So she had to write a
Yeah.
letter explaining why she got arrested way back then, for food stamp fraud. And it brought
Okay.
tears to my eyes because I didn't know the detail. I was, a kid. But when I read,
Yeah.
she said she had just got a new job. It was a 90-day probationary period, and she didn't know if she was going to make it for the whole 90 days. So she kept claiming to get the food stamps
Yeah.
to take care of children. And
Well,
so,
yeah.
yeah, and so that brought tears to my eye because she was doing what she needed to do, to
Hmm.
uh, to take care of her children. And so I'm
Right.
at a point now, my mom, she didn't have money, skills, and then teach us. I'm at a point now, I'm 55. I have a 29-year-old son. I have 3 grandchildren. So I'm at a point now that, I know I have setbacks because I started learning later in life, but I'm
Yeah.
not going to let it stop me or make excuses or play the victim. I'm just
Right.
going to learn what I can, share with others, and hopefully I can share with others and leave something for my generation. To when
Yeah.
I leave. So that's kind of my
Well,
mentality.
I love that, Troy, that, no matter, you're not letting how you were raised or the circumstances that, um, you grew up in affect you, and
Mhm.
you're still going to, keep pushing and then help others with what you've learned. And I really like hearing when people are like, damn the consequences, or screw how I was raised.
Mhm.
Yeah, it sucks, and we had to do without, but that doesn't mean I have to keep living like that.
Yeah,
And so I really appreciate that you mentioned that. So how can we get a hold of you if someone is interested in learning more about being more responsible with their money?
sure. They can go to my website, troyholt.com. That's
Mhm.
TroyHolt.com. That has my information of financial education. There are some videos on it they can look. They can also get on my calendar from there. They can
Mhm.
also, there's a click on to get a free ebook, subscribe to a newsletter. All that is there on the website. I'm very active on LinkedIn, so a person reach out to me on LinkedIn. I'm on all social media
Mhm.
platforms, Instagram, Twitter,
Yeah.
Facebook, but I'm very active on LinkedIn. So probably LinkedIn and my website would be the two places to go.
I love LinkedIn. I signed up for it feeling like I didn't really belong there,
Hmm.
but now that I've been on there and been contributing, I feel like, wow, maybe I am smart enough to be on this social media platform. You
LinkedIn's awesome.
know, I love it. And through my work from my 9 to 5 job,
Hmm.
um, they uh, gave us access to LinkedIn Learning. And
Okay,
so
good.
I get on there. I
Yes.
know I love it. I get on there and I set aside time almost every day and learn something from there.
Good.
And I made someone, I uh, upset someone and hurt their feelings, or I made them mad or something. So
Mhm.
they had one on there, how to be, how to make your coworkers love you. So
So
I
you
made
taking
sure
that class?
so I watched that one. My boss was like, nobody's mad at you. I was like, well, I kind of feel like it. Because I tend to just shoot off at the mouth sometimes and
Mhm.
say things that, I don't mean to. But
Yeah,
um, anyway, well, Troy, I so appreciate you coming on and talking to me today. And hopefully we can meet up again in the future
sure.
because, money problems and financial
Mhm.
troubles is always
Yes,
something to talk about.
true.
Thank you, Troy.
You're welcome. Thank you.